A warm welcome. Also, welcome to the second day's conference. I would like to thank Corporate Laws and Corporate Governance Committee, ICI, who has given us an opportunity to host this event. Now we have a session on CARO, a much awaited session, and we know Mr. CA Gururaj Acharya, a very well-known faculty in this. I request CA Manjunath Thalur, our treasurer, to welcome the speaker with a floral bouquet. I welcome you again, sir. With this, I would like to take the privilege in introducing today's speaker, CA Gururaj Acharya, who hails from the temple town Udupi, brought up in the Iron City, Bellary, and now well settled in the knowledge city of Bangalore. He is a qualified chartered accountant after completing articles under Guruprasad & Co, Bellary. He is presently the senior partner of Mrs. KG Acharya & Co, Chartered Accountants, Bangalore, specializing in corporate finance, corporate taxes, and company law. He is a director on the board of directors of Karnataka Bank. He was director on the board of directors of State Bank of Mysore. He was a member of the Karnataka State Level Audit Advisory Board, was a co-opted member of Expert Advisory Committee and Committee on Accounting Standards for Local Bodies by ICI New Delhi, was a member of Bangalore Financial Reporting Review Group, formulated under the Financial Reporting Review Group of ICI New Delhi. He's authored a book titled Internal Financial Control, Practical Handbook on Audit Report on What Can Go Wrong, published by Karnataka State Chartered Accountants Association. He's also a resource person on accounting standards and standards on auditing, Companies Act 2013 and LLP, corporate finance and financial analysis, corporate tax and tax audit. With this brief introduction, I welcome CA Gururaj Acharya once again, and I would like to present to you all the speaker of the day. Thank you.
Thanks, Pramod, for the introduction and escorting me to the stage. Thanks, Manjunath, for being here. Also for accompanying us to meet the Register of Companies a couple of weeks ago. I also thank Srinivas, the chairman, for giving me an opportunity to diving deep into this subject and getting to learn better by making this presentation. I always keep telling it was not when I was taught, but when I was teaching that I learned a lot. So teaching is a very good process of learning. So I thank Bangalore branch for giving me the opportunity again for learning a lot. Having said that, I think, I don't remember the date, but in February when Chairman Srinivas took over as a chairman, myself and MP Vijay Kumar, we spoke on the changes in Schedule 3. Schedule 3, there were a lot of changes. There were about, I just made a note of how many changes. There are about 10 changes and 26 additional disclosures to be made in Schedule 3 when we are preparing the financials. So logically, we have prepared our financials already. We know by virtue of what we already delved in the month of February, and those of you who were not there, I'm sure you would have gotten to know otherwise. But Bangalore branch has already held this program on Schedule 3 changes in the month of February. The live recording should be available in the web, so you can go and check. Having done that, so the next thing is we have to do the audit. Having done the financial statement, the next logical thing is to go ahead and do the audit. And having completed the audit report and CARO and IFC wherever it is applicable. IFC, there has been no changes, but audit report, main audit report, there are a couple of changes, which we also have discussed on in the month of February. But I can just briefly tell you the changes in the main audit report is the conduit lending. The auditor of a company has to comment whether we have received, we have given to a company in turn to be given to somebody else. So that aspect has to be told by taking a management representation, first of all. That's called Rule 11E and F. Rule 11E, the changes are ABC. In ABC, we had one is the receiving the company which is giving in turn to be given to another company is what has to be quoted. And in 11E B, clause B, we need to comment on if have I received anything as a conduit from somebody to be in turn given it to somebody else. So that is the second bit of it, B. And C, we are supposed to comment on A and B considering the management representation letter. C, 11EC, rule number 11EC, we are supposed to comment based on our independent audit, not only considering the management representation letter. Based on our independent audit, we are supposed to comment on 11E bracket C. Then 11F, we need to comment in every financial statement whether or not there has been dividend declaration, whether the dividend, if it is declared, has been declared as per section 123 of the Companies Act. Section 123 of the Companies Act deals with the dividends. We as auditors have to comment wherever dividends have been given as they have been complying with the section and the rules thereof. In case there has been no dividends, we have to accordingly say. So we need to have a additional 2 paragraphs in our main audit report. Now talking about CARO report which we need to give for companies which is required. There are certain companies for which CARO is not exempt, we will see that. But wherever we have to give, there has been a drastic change. Although it came in the year 2020, I would say thanks to Corona, it has been kept under pending for 2 years. So now CARO 2020 is what we have to use for those companies wherever CARO report has to be given. So that is what we are going to talk in detail today. And we have the advantage of having the guidance note from the institute. Incidentally, the guidance note on CARO came in the month of I think July 2020. Our institute was so proactive that this particular CARO notification came in the month of I think February 2020. 25th February 2020 notification. Whatever CARO has come in, whatever we are going to talk about, came on 25th of February 2020. Immediately in July 2020, our institute came out with a guidance note. Now, my discussion today will be based on the guidance, of course, the CARO notification and the guidance note, whatever the institute has told in the guidance note as issued in July 2020. But I need to tell you one very important development, that last month, our institute has given out an exposure draft on the guidance note, which is going to be revised. And I think the last date for giving the thing is 22nd of June 2022. Last day for giving the comments, if at all, on the exposure draft of the revised guidance note is 22nd of June 2022. Now, why did the institute give out in July 2020, and why is it revising in? Why is the guidance note getting revised now? The reason is there has been certain changes. In fact, when July 2020 the guidance note came out, Schedule 3 revision was not there. The Schedule 3 revision was not thought about. I mean, the institute, of course, did not know, because this came out subsequently. I think 24th of March 2021, the Schedule 3 came out. So, and there has been certain changes in the Companies Act thereafter, especially with respect to Section 135. There are, I mean, the CSR provisions in Companies Act have got notified. So in July 2020, when the guidance note came out, the Schedule 3 and certain amendments in the Companies Act could not have been foreseen. So therefore, to that extent, the exposure draft has come out. So while there may have to be another session subsequently just to talk about what are those changes, but today I am restricting myself to the guidance note which is issued in July 2020, as well as, of course, I know what are the changes that have happened by virtue of Schedule 3 and Companies Act. I will be delving into that also. The paragraph numbers which is coming in my guidance note, I mean, in my presentation here, is with respect to July 2020. So that is the brief with which we need to proceed further. Yeah, I will be talking today for 3 hours, session 1 and session 3. Although the second session, there will be a discussion on loans and advances, deposits, intercorporate loans by Company Secretary Tirupal. I will be handling 2 sessions. Session number 1 today, from 10 to 11:30. And again, from 2 to 3:30, I will be again concluding the CARO requirements. So that is the schedule for the day. And of course, the last session will be on penalties and prosecution under Companies Act 2013 by Company Secretary Sundaresh. Well, that is a very important session because there are huge penalties. As I think in the yesterday's session, when the Registrar of Companies spoke, Mr. Sajeevan spoke very well. He was sensitizing us about the various possible penalties that could come. So the reading of the penalties and provision is at the end of any section. That will be the most boring thing to read. But let me tell you, if at all a show cause notice comes, that will be the only thing that you will be looking into afterwards. The deposit chapter, the next speaker was going to talk about, in case there is any non-compliance with respect to the deposit provisions, the penalties can be as huge as 2 crores. Imagine I have given a wrong advice as a chartered accountant, or they have consulted me and I said everything is fine, and actually it is not fine. So then that the seriousness of that particular, and there is a penalty which is levied. If the client has never consulted us, or probably he has done and then come to us, no problem. I mean, then it is not my baby at all. But then if I have been consulted and I said everything is fine, and thereafter the penalty comes, I don't know who has to pay the penalty. I mean, I'm just telling you that the importance of penalty is not seen as much as it is to be seen. It is kept in the last session. In fact, it should have been the first session also, in a way. Okay. Yeah. I have this knack of somehow bringing the entire provision under one slide. I mean, I try my best to put the entire requirements in one slide. Now today I can talk about entire Schedule 3 in one slide. I mean, that is the slide that I've put up here. And I also put up entire CARO requirement in one slide. So these are the 2 slides that we will be spending more time on. Schedule 3, of course, we have already dealt with in detail in the month of February. But what are the changes? So what I have done here is, if you see, there are certain color combinations which are in the form of red, blue, and black. So let me tell you what it means. So I don't know, it may be looking small. I don't know whether Ranjanath, you're able to see that. No, not able to see. I can't help. Please come. I can't help it because Schedule 3, I have crunched it and put it in one PPT, but that's how it looks. Anyway, I will explain you because you are at a distance and I am at a closer to the screen. People who are virtually watching, maybe from the screen, they will be able to see as much as I can see. Now here, there are certain things in red, which means that in every Schedule 3, it will be there. When I talked about 10 and 26, 10 changes and 26 additional disclosures in Schedule 3, not all of the 36 items will be present and prevalent in every balance sheet. But there are certain things which will be there in every balance sheet, that is in red. That which is in blue may or may not be there. That which is in black may be very rare situations. Maybe very rare situations. That's the color code that I have tried to give here. So let's see what are all those things which are going to be there in every balance sheet. Now, first of all, a rounding off. Okay. Whether rounding off is a good thing or a bad thing. Good for the reader. It's very good for the reader because when I get my executive summaries and so many things I have to read, if somebody gives me in the nearest rupee and paise, I will be so wild actually. I mean, I will say I will be spending more time in seeing what the figures are than actually taking a decision on those figures. So from the reader's perspective, it is very good. So that is the reason why it has been suggested, rather mandated now. Earlier it was a suggestion, although in the AS it was always a mandate. Now for IGAP companies also, people who are following the regular accounting standards also, this particular rounding off is a must. So please take care of that. Earlier it was not applicable, or rather it was an option. Now it is revised. Change that. Not applicable, nikal ke option karo. Then current maturity of long-term debts. Current maturity of long-term debts. Earlier, it was grouped under other current liabilities. Now it has to be grouped under short-term borrowings. I would not like to get into the why of it, but I mean, although we have discussed the why of it in February, but today I'm talking about the what of it and how of it. What should be done? You will have to group it under other borrowings. You have to group it under short-term borrowings instead of other current liabilities earlier. Now, let me tell you a warning here. People who continue to show it under other current liabilities, even after 31/3/2022, because the first time 21/22 financials, you will have to group it under short-term borrowings. Now, if you continue to group it under other current liabilities, it will be considered as a technical mistake from the FRRB. There is a Financial Reporting Review Board. When it is a liability, wherever I show what does it matter means it does matter. Where you show certainly matters. So please be aware of it. Yesterday, the ROC was telling us casually in the room that even some of the balance sheets is still seeing as per section 273 1D of the Companies Act of 1956. I mean, there are companies which are still, and the chartered accountants are blind to that. So I think we have a responsibility of correcting it. So please don't put the term loan repayable within 1 year under other current liabilities from this year onwards. It should be under short-term borrowings. Similarly, security deposits, long-term loans and advances say earlier, now it is to be shown under other non-current assets. Now, changes in balance sheet or on the face of the balance sheet, we were showing property, plant and equipment was required to be shown by virtue of the change in the accounting standards, accounting standard 10. Now, what has to be also added along with that is property, plant and equipment and intangible assets. Wherever intangible assets are there. The question that comes out is, if I don't have an intangible asset, should I still give that particular line item? The answer is not required. You may give whatever is there only instead of giving a line item and showing it as dash. Now, changes in the balance sheet, again, the face of the balance sheet, what was earlier shown was tangible asset. Now we have to show property, plant and equipment. That's a change which is already shown. Now, changes in the profit and loss account, the total of the income side was earlier called as total revenue. Now it has to be called as total income. Now, these I will tell you, these are the 6 changes which are very, very apparent changes. I can know. Now, what I will do is, I'll take up the balance sheet of 21/22, the movement, I will see only 2 items, maybe rounding off, and the term loan repayable within 1 year, whether it is classified under other current liabilities or short-term borrowings. Now, looking at these 2 things, I will know whether the company the company here, not the auditor, and if the auditor has not qualified on the auditor also, that they have not updated themselves. So these are the 2 prima facie things. Then there are other additional regulatory information. One of the additional most important red, which I've given, is on the 11 ratios with numerator and denominator. And if the deviation from the last year is more than 25%, give reasons. You don't have to give an elaborate reason. Although you can, but what we have been trying to do is, because of the current ratio is low, what is the reason for current ratio being low? Maybe we'll have to say that there was a fixed, there was an expansion in the company for which the funds have been utilized. Or, yeah, one liner is sufficient. Or if you say that the net profits have dropped, and you'll have to comment only if it is more than 25%. The requirement itself, ratios, you have to give the numerator, denominator, what you have used, not the numbers. For net profit ratio, I have used PAT as my numerator, and denominator is my sales or total. In this context, I will use total income. I will not use the word total revenue because they have changed. I don't want to get into the why of it, although there is a reason why it is changed. So total income. So net sales, net profit after tax is my numerator and denominator is total income. So my net ratio. And is there a change? What is the percentage change? Let us say between last year and this year. I have to give the last year and this year also. So if it is more than 25%, I will have to give a 1-line reason as to why there is a change. So the net profit ratio last year was 35% and this year it is 20%. You see the difference between 30% and 25%. 30% last year, 20% this year. 30% last year, 20% this year. Is the change more than 25%? Is the change more than 25%? No. Last year it was 30%. What is, how do you calculate? You are not calling about, you are looking into, you should give a command in your Excel such that the difference between this percentage and this percentage, not the apparent percentage. So 30% and 20%. So the difference is more than 25%. And therefore you have to say the drop in revenue. The reason being the reduction in the operation is the reason. Then you don't have to say because of COVID and because of so many customers going out, because if you give on, then you will have to write a story on that. I mean, further reason, if you don't have anything else, you can go on explaining. Now, if you want to explain, you can. Nothing stops you from explaining. Those things are also there, yes. No, but that is the company's version. Of course, you will have to verify that. If the company wants to give, can you stop them? The company says, I want to explain. You will have to see whether that explanation is genuine. I think that is where it lies. Okay? So 11 ratio. And in fact, last time we had a debate. I mean, some of the ratios are plain. I don't want to talk about that. But the last ratio, there was a return on capital employed. I don't know, Pramod, you were part of our discussion. Return on capital employed and return on investment. Both, I mean, I used to teach financial management and I used to say that both are the same, return on capital employed and return on investment. But our guidance note, there is an guidance note on schedule 3, which then gave a different ratios for the two, Then subsequently we got to know after reading so many companies that what is expected on return on capital employed is on the capital that I have deployed. What is the return? That is very simple. My operating profit divided by long-term funds, which means PBIT divided by my long-term funds, which I thought for return on investment is also same. But then return on investment is afterwards, if you look into, is if I have any investments, in my balance sheet, on that investment, what is the return that I got? That is what is expected, although we did not know because the notification was not that clear. Subsequently, maybe some of them have spoken to MCA and found out what is your intent. Then they said, if you think of the balance sheet, return on capital employed is on your capital employed. You must have got your profits. So how much is your operating profit divided by your capital employed? Whereas return on investment is on the asset side. If there are investments, on that investments, did you get any dividend? Did you get any interest on? Was there an appreciation in the value of the investment from last year to this year? So that is the return on investment that they are talking, and that is the correction from the last time to now. We have been enriched to that extent. Even in the guidance note, they did not talk about that. They just gave the ratio. That is where our confusion was. If they had told that this is what is the purport of that particular thing, and that is why this ratio, we would not have probably challenged at that point in time. Sure. Why don't you take the mic? Give the mic, no? Yeah. No, I think you will have to do that. If at all you have an investment, okay, let me now talk about one thing. If you do not have investment, this ratio obviously will be, don't write dash, not applicable is the answer. If you write dash, there is a possibility that the people may think that it is actually zero. Now, that is the first thing that I want to tell. Then if I have a subsidiary, a strategic investment, should I give this ratio yes or no? In my opinion, it has to be given because there is an investment. What is the benefit you got out of that investment is what is thrown out by this ROI. Therefore, you'll have to give.
Because if you look at the guidance note and the formula given, it talks about T1 time value of the one. So then you might have to probably do a fair value and then give the return as well. So that might be cumbersome. So should we exclude or give a note and say that?
Forget about this. Suppose you have an investment in a private limited company. How will you do that?
Books it is carried at historical cost.
So you will have to you will have to probably work out the ratio at historical cost only, in which case it may not be yielding any return.
Exactly.
Or if you want to give something, then there should be an evidence to give that. The evidence is probably finding out that company's net worth and what is the last year net worth, this year net worth, and working out like that.
So can we give that this does not include investment on subsidiaries as a note, or will it be treated as in compliance?
Although there is no guidance, I think we'll have to derive our own path. Okay? If you want to give a justification why you have not done, maybe that is a good enough. You will want to prove that it's a strategic investment yielding long-term benefits and so many other things. You can give that as a note. The guidance note is silent. Okay. Now, quickly I will go through what are the other changes that could be there. What is in blue? Again, people who have joined now, Prakash sir, thank you so much for always being there to encourage me. So what I've done is, sir, Schedule 3 changes in red, blue, and black. Whatever is in red will be there in every balance sheet. The moment you have a SIN number, but I'm emphasizing on the word SIN number, they are warning you that it is a sin to form a company. So, and therefore you will have to have all these in such a company in red. In blue, because we were seeing there are a lot of changes in Schedule 3, some of the changes may not be applicable to most of the companies. So that is given in black at the end. But that which is in blue, mostly it may be there. I mean, it may be there, it may not be there, but I mean, that is how we have segregated. So loans are advances in the nature of loans granted to promoters, directors, KMPs, and related parties. Details of charges, satisfaction pending with reason. Whether details provided in the quarterly information system are in agreement with the books. If not, record reasons. The same thing you will get it in CARO also. Details of relationship with stuck-off companies, the most challenging one. Although CLCHs, which is actually, yes, sir. No, I can't help you, sir. No, maybe I'm therefore reading it out because this is how the screen is now. Okay. Now, details of relationship stuck-off companies. What I was trying to say, CLCGS is coming out with they're talking to some of the vendors to come out with the like in the case of the TDS. If you don't file your returns for 2 years, you specified as a C, you can, now it is 1 year, where you put in the PAN number, you will come to know whether they are specified as a C or not. Like that, you put in the SIN numbers, you will come to know whether they are stuck-off companies or not. So they're coming out with a whatever an app like that. So we'll see till such time if we have to sign balance sheet, we'll have to blame it on CLCGS. Yes. Yeah.
Most of the companies, when they created their vendor master, because this does not talk only about the investment, it talks about any transaction.
It talks about every company in your balance sheet,
exactly.
Every personal. And I always put it like this: we have real accounts. Going back to first PUC, real accounts, personal accounts, and nominal accounts. Okay, real accounts chhod do and nominal accounts chhod do. Personal account means that which is in the name of a person. If that person happens to be a company, anywhere in your balance sheet, persons cannot be in the profit and loss account. Huh? So anywhere in the balance sheet, you will have to now study this.
This is the practical difficulty we are facing currently, because when they created their vendor master or any master, customer master, they have never taken the SIN number of it, be it a listed company so far. So, and even the ledger naming, when we look at this transaction, they will give spaces, they'll give this. So we are facing high challenges in this, and even the MCA had not even put in earlier when they wanted to bring in this. And this has been.
No, I think the only way now is you will have to capture that. You have to capture the additional field, and for the company, they have to check for everybody. As far as the auditor is concerned, he can of course go by the test check. Okay. So details of title deeds of land and building not held in the company name, there in Schedule 3, there in CARO also. Whether revaluation of PP is done, if yes, is it done by registered value, again there in CARO. Aging and completion schedule of capital work in progress. So wherever it is there, it will be there. And now you see whatever is in black may be very rare. Intangible assets under development. Hoga sir aapka company mein? Both come. That's how I'm putting. Then aging and details of Benami property held. No, very rare situation. But then if it is there, hum rare bol ke black bol ke chhodna nahi. That's the point. We should keep it. We should keep track of that. and willful defaulters. We will also have this in CARO. Maybe you put a star wherever CARO things are there. Vinay, put a star wherever CARO things are also there in this. So willful defaulter, compliance with number of layers of company, 186, read with section 2, subsection 87, again there in CARO. Compliance with respect to approved scheme of arrangement, if at all. I mean, both companies mein hota hai. Then details of conduit lending, funding and intermediary. So if I'm a funding party or I'm an intermediary party, also which is there in the main audit report. Other disclosures, shareholders pattern of the promoters. It will be there in every company. Why I put the first one is structural. The second one is the additional regulatory requirement. If you remember last time we were talking about regulatory requirement 14 points. But those 14 points, I and Vijay Kumar, we were discussing whether it should be given under a particular heading or can it be scattered all over. Although he mentioned that it is preferred, I mean, he said that the intention is to give under a specific heading. But then today, so many balance sheets we have seen, and I also would like to do that, scatter it all over. The reason is, suppose it is capital work in progress, I give it below capital, the fixed asset schedule itself, rather than again giving it elsewhere. So it is comfortable for the preparers and probably for the readers also. So regulatory, they don't trust that it should be all there in one place, point to be noted. Then there are other disclosures, shareholders pattern of promoters. So every company will have a promoter. Let us be very clear, promoter, let us say promoter has, it was formed by OP Jindal sir. Yes, sir, you said that you have formed JSW. Okay, so you are the founder of JSW. Promoter of JSW is OP Jindal. Now, can we say that he is no more and therefore there is no promoter? His son is there, Sajjan Jindal. So he is holding the shares. So he is the promoter of the company. So promoter is not the person who has promoted the company, but anybody who steps into the shoes of the promoter becomes a promoter. So SEBI therefore wanted to remove the word promoter and call it as person in charge. A better terminology. A person in charge. So we have to consider promoter as a person in charge. Okay? So, yeah. Whoever you have named promoters in your annual return or in your practice, then promoter should be named as such in, there must be somebody. I mean, that's how we would say. So you don't have anybody. Okay. Yes, sir. Aging of trade payables, granular details. Earlier it was only 6 months and I mean, of course that was for the debtors. Creditors, it was only MSME and others. Today you will have to give the classification. Aging of trade receivables, both under current asset and under non-current assets, again granular. Earlier it was 6 and more than 6, now it is granular. So CSR details has to be given. We'll discuss that. Disclose usage of borrowings from banks, financial institutions not used for specific purpose, also there in CARO. Undisclosed income to the income tax department, also there in CARO. Cryptocurrency or virtual currency default. So this is at a snapshot the changes in schedule 3. We come to CARO 2020. Now CARO 2020, there has been, to whom does it apply? Let us say, to whom does it apply? There has been no change from CARO 2016 and CARO 2020. Applicability has been the same. If it was not applicable for a particular entity in 2016 CARO, it is not applicable in CARO 2020. That is how it is. But let us refresh our memory to say, again, a word of caution, if at all you are doing the financials of 2021 now and giving the audit report for 2021 now, you will have to use the CARO 2016 only. The audit report and CARO will be pertaining to the year and not the date when you sign. Yeah, that's a point to be noted. And now, what are the changes? Applicable to every company for financial year commencing on or after 1/4/21, that is CARO 20. For audits for the previous the respective CARO shall apply, including foreign company, government company, and branch companies. And except, who are the exceptions? Banking and insurance company, Section 8 company, 1% company, small company, and private companies having the following: not being a subsidiary holding of a public company. Now, if it is a private company, which is a subsidiary or a holding of a public limited company, you don't have to test the following, but you will have to test whether it is a small company. A small company, the moment you have a holding or a subsidiary company, you will not be a small company. That's a point to be noted. So therefore, if you are a holding, not being a subsidiary or a holding of a public limited company, then in a private limited company, however small it is, CARO will be applicable. Now, what are the criteria to be checked for a private limited companies? If at all, they are not small companies. If they're already a small company, you don't even have to test this particular criteria. Now, what is the definition of a small company? Paid up capital is less than 2 crores and turnover is less than 20 crores. For the last year itself, the change has already happened. Paid up capital less than 2 crores and turnover of less than 20 crores. And any one of them breaching, you will not be a small company. So both of them complying, less than 2 crores paid up capital and turnover less than 20 crores, and being a private company, you should be a private company, but not a holding or a subsidiary or a Section 8 company, then you are a small company. If you are a small company, you definitely don't have to prepare a CARO. So for a private limited company, first of all, first check you'll have to do is whether I am a small company. If I'm a small company, no further work, no CARO. Then if I'm not a small company, I will again test whether my paid up capital plus reserves and surplus is less than 1 crore. And my total borrowing from banks, financial institutions, non-banking finance companies less than 1 crore. And total revenue is less than 10 crores. Again, all the three conditions complied with. Then for such a private limited company, not being a small company, I will be exempt from CARO. Yeah. Any questions here? Yeah. If CARO is not applicable, do I keep quiet or do I bring a note? If CARO is applicable, I will put it in my main audit report that please refer to Annexure A, Annexure B for IFC, Annexure A. If it is not there, do I keep quiet or should I give a statement in my main audit report? It would become, although it is not told very specifically, our guidance note in 2016, they mentioned this, and also in 2020. I mean, it was there earlier, but not in guidance note of CARO 2016 and 20, but better to give nevertheless. So what does it say? Yeah, I think Manohar Gupta sir is there on the screen. I can see him. He has just warned that just because you are an SMC, a small and medium company for the purpose of accounting standard, is not the same as a small company for the purpose of other exemptions under the Companies Act, one of them being CARO. They could have done small company altogether in a different way. They said small and medium company. So that is why SMC is different for the purpose of accounting standards. Yeah, so what is a note that we give? We say that this report does not include a statement of CARO because in our opinion, it is not applicable to us. Next, applicability of CARO. Now we have seen how the times have changed, how the times have become tougher and tougher. With every scam done by one particular company somewhere remote in the country, all the companies there has been an increased compliance requirement. Whether the fee has increased, whether the cost has increased, how did the cost, both the cost and the time has increased. As far as the chartered accountant is concerned, although we talk about opportunity cost in a very big way, I mean, costing me opportunity cost, hum log seekh gaye, but we are not putting it into action. The time that we spend for a particular case is one thing. Forget about that. That is charity because we do professional social responsibility, corporate social responsibility. Having done that, can I now depend only on my articles to prepare Schedule 3? And so what do I have to do? I will have to hire costly resources. So cost has gone up, but the fee has not gone up. So all of us collectively here, we have to pass a resolution now. The work has gone up at least by 50%. You will see that at least by 50%. Okay. But the fee, has it gone up, sir? सर आप बढ़ाएंगे तो हम भी बढ़ाएंगे, आप नहीं बढ़ा रहे, नहीं, ओके सर। 2016 there were 16 points in CARO, and 2020 how many points are there? There are 20 points plus 1. Yesterday ROC was talking of 21 points. Yes, it is, I would always say 20 plus 1 to be dealt with separately. For a standalone company, it is only 20 points. For a CFS, consolidated financial statement, it is only 1 point. It is only 1 point. Now, what is that 1 point? हम बोल के खत्म कर लेंगे कि 1 point is what are all the adverse or negative observations that are found out in the standalone financial statement. Give the paragraph number of that. That's it. So in a consolidated financial statement, of course, you will have the main audit report. You will also have a CARO, and that CARO will contain only the paragraph numbers of the adverse or negative comments in the standalone financial statement. So for that, you may not decide to give an annexure also. You can give it under the main audit report itself. Under main audit report for 143, whatever that section is, so you 11, right? So under that, you give the, instead of giving that particular reference, you will say that the following are the observations are negative, or you say that there has been none. In the standalone financial statements, there has been no negative or adverse observation paragraphs. The challenge comes in for a consolidated auditor. What are all the adverse and negative? I will tell you one situation. Does the company have an internal audit system? Does the company have an internal audit system? Now, is internal audit system required by commensurate with the size and nature of the company? That is the query when we go to that. Now, the possible answer is the company does not have an internal audit system commensurate with the size of, does not have an internal audit system, and the company is not a class company under section 138. Because under 138, there are only a few companies where it is mandated. Now tell me whether this particular observation which I made is an adverse or a negative. The question asked in CARO is, if you see the question in CARO, it talks whether the company has an internal audit system commensurate with the nature and size of the company. It is not linking it to 138. It is not linking it to 138. Under the guidance note, they have given this answer, what I told you. The possible answer could be the company does not have an internal audit system, and it is not required to have an internal audit system as per section 138. Now tell me whether it is a adverse, क्या बोलते sir, whether it is adverse or now. So therefore, in our office, we were debating, can we, instead of the word and, can we say as it is, not required to? I mean, I'm just trying to play with the semantics, but can it get a different, if you say and it is not required to have this thing, that means the first statement is negative. The second statement is independent. But if you say as it is not required, maybe it will go with the flow of things. The point I'm trying to finally say is, as a consolidated auditor, if such a statement is made by one of the component auditor, will you consider it as a negative adverse or otherwise? What is the guidance given by our institute in the guidance note? They said in such context, you ask this component auditor only to say whether it is a negative or you have a joint discussion. And finally, it says the responsibility, of course, is on the consolidation auditor only. I leave it at that. Now, this is on the consolidation. Then 20 points. So CARO 2020 में 20 points. CARO 2016 में 16 points. That means every year, with every changing year, I keep telling this for tax audit report also. Tax audit report में अभी कितना से 40, 44. I mean, those days I used to say it is going in relation to my age. No? So fortunately, I am 44 years old. I say stop. The point I'm saying is, so many changes with effect from 1920 onwards. Of course, it is written there, but it is from 2021. So beware of the impact. Whenever you are preparing a CARO, beware of the impact between the CARO and the main audit report. There cannot be something in CARO and some, I mean, if you are saying that the disclosures are not okay with respect to loans and advances and things like that, maybe then your financial statement also is a misstatement. So to that extent, it can have a bearing on not every comment in the financial state CARO may need to a qualification in the main audit reports. But there could be certain things in CARO which is pervasive, because of which your main audit report also has to be changed. CARO and banking, whatever you are giving in the CARO report, now bankers will have it will have an impact on the bank. For example, the QIS statement, the quarterly information statement, the bank will pounce on them. So therefore, warn the client that we are commenting on that, and therefore be aware. CARO versus Income Tax Act, Section 185 versus 222E, loans to directors. When I can give maybe under Section 185, there could be a situation where I'm giving it to a subsidiary a holding company back, and intercorporate loans are probably now exempt under 185. But under 222E, it could be. So if somebody comes to you and say, can I give a loan? And then I look into 185 and say you can. It could be leading to 222E violation, deemed dividends. Section 42 versus Section 56 to 7B. Section 42 is basically private placements. When I am doing a private placement or giving out additional shares, I have to be wary of the premium. Any premium which is charged in excess of the book value, the fair market value, will have to come under taxation under 56 to 7B. Section 188, 197 related party transactions versus 48(2)B and transfer pricing. So this is what I told you. ICI guidance note on CARO is 2020, released in July 2020, under construction. I mean, exposure draft has come out where there will be a new by virtue of Schedule 3 changes and changes in the Companies Act. Yeah. So this is the comment that I was talking about. Where there have been any qualifications, whether there have been any qualification, again, how do you read this? If anything is in red, I mean, the entire thing is looking like a Karnataka flag, right? Yellow and red. Anything in red means it is a new requirement. Means it is a new requirement. As and when you see this, you will see that. Clause 21, applicable only to consolidated financial statement. What is the question? Whether there have been any qualification or adverse remark by the respective auditors, in CARO reports of the companies included in the CFS. If yes, indicate the details of the companies and the paragraph numbers of the CARO report containing the qualification or adverse remarks. Points to be noted. You don't have to reproduce the qualifications. I mean, you don't have to reproduce the observations. You just have to say which are the paragraph numbers which are carrying what report? Qualifications or adverse remarks. Now, then provide paragraph numbers of CARO report containing the qualification or adverse remark. Text of those paragraphs not required to be reproduced. Nor need, I mean, this is another question. We always keep telling in IFC of a component, and IFC of a consolidated. If something from the consolidation perspective is not material, although it has been commented, even in the main audit report also we keep telling, if the qualification is not material from the consolidation perspective, you may ignore that. I mean, you may not consider that qualification in your consolidation. But this is not true for this particular comment. Because he is very clear that I want the negatives in the respective components. So whether or not those negatives are material from the consolidation perspective, you will have to comment it in the, because after all, you're not reproducing the paragraph, you're only giving the reference to that particular paragraph. Are we clear? Okay. So no need to re-evaluate materiality from a consolidation perspective on the above clause. And that which is given in blue in the extreme left, these are all the paragraph reference numbers in the guidance note. Okay, so it's paragraph 37 read with 85F of the guidance note says no need to re-evaluate materiality from a consolidation perspective. Every qualification or adverse remark made by every individual component, including the parent company, should be included while reporting on the above clause. And this we have already discussed. How do you find out whether it is negative or adverse? So you ask the component auditor, but finally it is the ultimate responsibility of the main auditor. In fact, those of you who are filing the AOC 4, right? You will have to give within your AOC 4 what are all those, all these things will come out, right? All these things, let me tell you, I told you 20 paragraphs. 20 paragraphs. If you break it up, it will actually be 48 questions. Especially if you will see some on question on loans and advances, A, B, C, D, E, F. If you consider A, B, C, D, E, F as 6, for 20 it is considered as 1. But actually the breakup, if you see, there are 48 questions that needs to be answered. Okay. So now in the AOC 4, there are 20 questions only. So, right, they have not broken up into 48. They have asked 20 questions. If there are any adverse or qualifications, you will have to give that. So para 4 of CARO, reasons to be stated for unfavorable or qualified answers. Let's have a glance. At a glance, what are the changes? What is that newly added? What is that which is modified? That which is retained, and that which is deleted. Deletion is very simple. Managerial remuneration has been deleted. What is the reason? 197 is applicable only to public limited companies, not to private limited companies. And public limited companies, by section 197, in the main audit report itself, you will have to comment on this. In the main audit report itself, with respect to the other matters to be included in auditor's report, section 197, in our opinion, best of information according to the explanation given to the remuneration paid by the company to its directors during the year is in accordance with the provisions of section 197. Now, where is it told? That the comment on the managerial remuneration with respect to public limited companies has to be told in the main audit report itself? 143.3 is the scrutiny order. 143.3 is also the scrutiny order of the auditor. When the auditor gives the audit report, section 143.3 of the Companies Act says what are all the matters to be covered in the main audit report. Section 197 dealing with managerial remuneration, there is, I think, 197 subsection 12 goes on to say that in the case of every public limited company, this matter has to be covered under 143.3. So not in 143.3. All the regular matters is told in 143.3 itself. 197 says so, and accordingly, you will have to now give the comment on the managerial remuneration in the case of a public limited company in the main audit report. It is not applicable for private limited companies. Main audit report, you are giving it in the main audit report itself for public limited companies. So therefore, they have dropped it from CARO. So what is retained? Deposits, cost records, loans, investments and guarantees, application of funds, related party transactions, non-cash transactions, and payment of statutory dues. All of them continue. What is that which has got modified? The inventory verification was always told to be commented in CARO, but what they have now told is if the variance between the book records and the actual physical verification is more than 10%, you will have to suggest now. You will have to mention that in the CARO report. And agreement with quarterly returns given to the banks. They are in Schedule 3, also there in CARO. We'll discuss that. Loans, advances, guarantees, or securities or investments given, scope enlarged. Earlier it was only for 189 parties, now to any party. The compliance of provisions with respect to deemed deposits also. Yesterday, I don't know, Pramod, you were there? Deemed deposits. Deposits today, no? No, yesterday. Discussion on loans, yeah, today. Today, then Mr. Tirupal, once he comes. Deemed deposits. We have deposits. We have deemed deposits. Now, what is deemed deposit? We'll talk about it. But then compliance of provision with respect to deemed deposits also. Earlier, it was talking about only deposits. Default in repayment of dues was asked. Now, additional thing that I've asked is term loan, if diverted, where have they been diverted? Funds taken to meet subsidiary. Have I taken any funds to meet the obligation of my subsidiary associates or joint venture is also to be commented now. Reporting of frauds, slight modification, Nidhi company and registration with RBI. There has been certain changes which is required now in CARO. Newly added, unrecorded income disclosed in the income tax assessment, whether it is properly recorded. Ability of the company to meet liabilities in the next 1 year, whether the company is able to meet the liabilities in the next 1 year. Very, very loaded questions. हमारा फीस नहीं पे की है. Can we now say, I mean, मेरा guidance note अगर मैं author होता तो मैं ऐसा लिखता, if your audit fees is being paid in time, you can give this as a favorable comment. I mean, this is in quote, by the way. Now, ability of the company to meet liability in the next 1 year. Our institute in the guidance note has given a very, very good manner in which it has to be reported. Because if you report this and tomorrow the company goes fat, when you will be hauled up saying on what basis you will give. Of course, the basis you will have to have proper audit documentation. This is the institute has gone to the extent of saying whether it is having the ability based on the financial ratios. Now, should you look into the financial ratio as on 31st March, or if you are signing the balance sheet in August, should you look into the financial ratios as on 31st August? So the guidance note has said you have to look into the ratio of that and this. So to have this ratio, you should have the financials done up to that date properly. So many, therefore, I mean, they have told that. And finally, the wordings have been given very nicely. I think it is better that we, instead of saying the company has the ability to repay the liability arising in the next 1 year, a plain answer like that, there has been a better wording which the institute has given. We will talk about that post lunch. CSR, transfer of unspent amount to the fund. CSR, please be very careful. Yesterday, whenever we go to the ROC, I mean the register of companies, Mr. Sajeevan especially, he is so passionate about CSR that if somebody has not spent the CSR, definitely penalty. Definitely penalty. Penalty is how much? 2 times the amount that you should have spent on CSR, plus you have to spend CSR. So might as well. And now, like the scrutiny of the income tax return, which we were always very, we are talking about scrutiny means only 143.3, 148 now. Now the scrutiny under the Companies Act is also getting done in a very bigger way. Why the ROCs have been, yesterday I was talking about, I don't have a role in company formation, name clearance, so many issues, because they want them to be free for doing the technical scrutiny. So they will be only doing technical scrutiny, and thereafter you will have all the penalties and provisions, compounding and all those things coming in a big way. Now CSR, let us deal with that very seriously. It may be, as on 21st of January 2021, okay sir, all the sections in section 135 has been notified. So what does that mean? If earlier the CSR spending was either an option, you can spend it or give a reason why you have not spent. That's what the ROC was talking yesterday. Now it is not an option. You shall spend it. You shall spend it or transfer it to the government funds or transfer it to the government funds. So what is the time frame? What is the criteria for CSR? First of all, 3 criteria. If your turnover is more than 1,000 crores, profit is more than 5 crores, net worth is more than 500 crores. Okay, these are the 3 criteria under 135. Mostly in private limited companies, 1,000 crore, 500 crores may be far-fetched, but the profit will be the first. Profit of 5 crores will be there. Now, any one of them breaching, including a private limited company, you shall spend. In which year, sir? Which year's profit you are looking into? Looking into, let us say 2021-22, you are signing the balance sheet. and turnover ज़्यादा नहीं है, net worth no problem, but their profit is now 6 crores. Profit is 6 crores. Then they have to spend 2% of the average profit for 21-22, 20-21 and 19-20. Last 3 years, average profit ka 2% when in 22-23. In 22-23. So the criteria that you are now looking into is 22-23 you have to spend. If you don't spend in 22-23, then you have two options. By let us say 2% of the average profit comes to 30 lakhs. Now 30 lakh rupees you have to spend in 22-23. If you did not spend this 30 lakhs within 22-23, you have two options, either to call it as an ongoing project or unspent. If it is not an ongoing project, within 30th September 2023, you have to transfer it to a fund. You'll have to transfer it to a fund specified in Schedule 7. Okay, it could be PM CARES or PM National Relief Fund or whatever. CM is not considered. Please be very careful. CM is not considered in Schedule 7. So Ganga project, so many things like that they have told. So you have to transfer to any of the funds specified in Schedule 7. If you say that it is an ongoing project, then on 30th April 2023 of the subsequent year, it could happen for 21-22 also. So 30th April of the next year, you will have to put it in a separate bank account and spend it within 3 years from that date. Failing which, within 30 days from that date, you will have to deposit into any of the Schedule 7 funds. So this is the requirement under section 134, 135 now, already applicable for 2021 itself. From 2021 itself, it was a mandatory. So 21-22, of course, now you'll have to sit with your clients and say whether it is ongoing or not ongoing. If they had to spend some funds in 21-22, if it is not ongoing, by 30th September 2022, they should have remitted it. Otherwise, by 30th April 22, they should have opened a separate bank account. Time gone already. And if you want to prove that it is an ongoing project, and if you have not deposited in a separate bank account on 30th April, that means you don't have an option of calling it as an ongoing. You will have to now put it under the straight away the not an ongoing project. You will have to spend it, give it to the Schedule 7 funds. Yeah. Provided there are certain conditions. They should be registered under by filing CSR1. They should give you a report of what they're spending. The question came out is, should they spend it within this time or do they have additional time? They should also spend it within this time. If you just give it to them, it doesn't amount to ultimate spending. You cannot use this as a conduit and say to buy additional time I'm giving them, and then they do it at leisure. वो भी नहीं है. So yes. No. There are various mechanisms under which it can be done. It can be the company set up trusts or outside trusts. And there are certain conditions. If it is a company set up trust, if it is an outside trust, it should be minimum for 3 years and things like that. It could be either a company set up trust or a group of companies which can set up the company's group. Now, statutory auditor resignation. Comment on the resignation of the statutory auditor in case have you consider all the adverse remarks or comments given by the earlier auditor who has resigned. Proceedings under the Benami Prohibition Act. CFS, reference to negative remarks in the subsidiary CARO. Internal audit system, comment on internal audit system, and cash losses. Cash losses, very interesting. So cash losses, is there a requirement for us to go through the guidance note? Very interesting point has been told by the guidance note. What they have told is, how do you work out the cash losses? Very simple. No? You add back depreciation, add back amortization, add back impairment losses. Then they went on to say, in case there are any qualifications in the disturbance. The class nadili, but they are having some effigy. I don't know what it is. Okay, what were we talking about? Yeah, cash losses. In case you have given a qualification in the main audit report, in case you have given a qualification, the stocks have been understated by or whatever, overstated by 30 lakhs, and your cash loss, as you work it out from your Excel, from your numbers, comes to cash loss of 70 lakhs. And in the main audit report, you said the stocks have been overvalued by 30 lakhs. The impact of that qualification must also be given in, when you are giving the, you understand? So your audit report should be in tandem. Your audit report, main audit report, mein kuch bol diya, yeah, it cannot be just a. So you will have to now bring the impact of that overvaluation here and say 79, 1 crore. Your loss is actually 1 crore. And you'll have to give a statement there because the reader may think only how did 70 become 1 crore if he is able to calculate. I mean, we were saying why this note at all. Anybody can calculate what is a cash law. Anybody means an intelligible reader. Then you may say not everybody is intelligent. Then even if for such a person, even if I say it is 70 lakhs cash loss, he will never know what it is. But the point I'm trying to say is, if he can calculate, why I should give away. That was the point that we were trying to say, but anyway, it is included. Yeah. We were talking about 48 points or 20 points. Let us not talk about 20 points. If a particular point is not applicable to me, should I still cover it and say it is not applicable to me? Or like in schedule 3, I can just eliminate and say only 17 are applicable or only 12 are applicable. What is your answer? The guidance, the notification itself has told that every report made by the auditor under 139, 134, 143 on account of every company audited by him to which the order applies shall in addition contain the matter specified in the paragraphs 3 and 4 as may be applicable. This was missing in earlier thing. From 2016 onwards it has come. So we have been telling that if a particular thing is not there, you don't have to really, if CSR is not applicable to you, CSR is not applicable to you. In the main audit report, the 143.11 requirement, to the extent it is applicable, I mean, I think maybe I'm not given that. To the extent it is applicable to me, have been covered in annexure A. You understand? So I don't, CSR is not applicable to me. So I am saying to the extent applicable to me have been covered in annexure A. So there I will give instead of 20 points, only 12 points. Clear? Yeah. But there is a word of caution. Don't consider those 12 points next year as your opening balance. And comment on that. In that year, if CSR is applicable. So that is why there is another thought process or a thinking school of thinking where they say we will cover all the 20 points. If it is not applicable, we'll say this clause is not applicable. That is another thought process. So you can decide accordingly. Now, sir, you know 143.3 May, how many sections are referred? And in CARO, how many sections are referred? I am saying that every auditor who is doing a company's act audit, I mean statutory auditor of a company, should at least know these sections. That is why I think it was very wonderfully designed by Bangalore branch, I should say, that the most relevant sections have been covered as a separate session itself in this 2 days workshop. Okay. Now let's see what are those. 133, accounting standards. Accounting standards. Now this is a very important thing. Read with rule 7. Read with rule 7. From now onwards, you cannot use this word read with rule 7. All these days in my main audit report, I used to say companies accounting standard rules. 2006, read with rule 7 of companies accounting standard rules 2014. Now what has happened is, what does this rule 7 say? My company's accounting standard rules was given out in 2006, before the birth of 2013 Act. Before the birth of 2013 Act. 2006 May company's accounting standard rules came out. And there we used to say that rule 7 of the company's accounting standard rules said that until accounting standard rules comes out through the 2013 Act, refer to 2006 rules. So that rule 7 was the bridge there. Now, from this year onwards, I cannot use rule 7. What should I say? I have followed company's accounting standard rules 2021. In 2021, entire company's accounting standard rules, जो भी 1 to 29 accounting standards were there, word by word has now come in company's accounting standard rules 2021. So 134 subsection 5, director's responsibility statement in the board report. 143.3, of course, audit report. 143.3.1 IFC with reference to financial statements. 143.8 branch office accounts if it is applicable. 143.10 standards on audit, most important. 143.11 CARO. 164.2 disqualification of directors. So we need to know when they are disqualified. I mean, we cannot just say based on written representations. Can I just say based on written representations? While based on written representation is going to be protecting me prima facie, but my gross negligence can also be proven otherwise if I don't do my independent due diligence. 197.16 overall managerial remuneration applicable only to public limited companies. Now, this is the CARO that I was talking about in one page. We talked about schedule 3 in one page. We are now talking about CARO 2016 versus 2020. You will see that. What was there in 2016? What is the change in 2020? And also you will see what are all those things which are referred to in schedule 3 here. So this is one slide. I will call it as the Vishwarupa of CARO. Now, Vishwarupa, everything of CARO is shown here. But here a point to be noted is there are 20 points in CARO. 20 points in CARO. But when you are doing CARO audit report, main audit report, we saw at least you should know 9 sections. When you are doing CARO, you need to know at least how many sections, sir? It's there at the end and the top, 15 sections. 15 sections you should be knowing very clearly if you have to do the CARO, comment on CARO. Like for example, yesterday the ROC was talking about section 42 compliance. Section 42, whenever a company is giving out private placement, have there been any private placements during the year? If so, have all the provisions with respect to section 42 been complied with? So I have to know the entire provisions of 42. One of the companies, he was telling yesterday that they have collected 54 lakhs as share capital through private placement and they have not opened a separate bank account. This 54 lakhs has come inside in the regular operating account. Whereas section 42 says that you have to open a separate bank account. And for not, you have done all other PAS, 3 issues, PAS, filing, etc. Everything has been done perfectly. But just because you did not open a bank account separately for this, you have breached section 42. What is the implication? There is a penalty, etc., etc. Forget about the penalty on the company. What is the duty of an auditor? First duty is he should know what is section 42 and know all the provisions. Has there been a private placement? If the answer is yes, have they complied with everything? If even one of them has not been complied with, it becomes my responsibility to give it in my CARO report. So to that extent, 42 I should know. That's what I'm saying. How many sections I should know if I have to do a CARO report? Section 185 and 186. Loans, investments, guarantees and securities. I think that is what is being talked in the next session. 2 sections, section 185 and 186. Section 73 to 76. Deposits. What is deposit? If you ask what is deposits, section is very, very clear, read with the rule. The definition as well as the rule is very clear. It says deposit includes any money received by the company. Any money received by the company is deposit unless it fits into any one of the 18 exemptions. They have given 18 green channel, I will call it. It fits into any one of the 18 green channels, then it is not a deposit. Otherwise, any money collected is deposit. Now look at this. In the balance sheet, we'll share, if you look into the from top to bottom, money collected could be share capital. Is share capital a deposit? Is share capital a deposit? Share application money, because when you collect it, it is share application money, and when it gets allotted, it becomes share capital. Share application money, whether it is a deposit, whether share application money is a deposit, the answer is yes, if it is not allotted within 60 days, complying with all the requirements again. If it is not allotted within 60 days, it could become a deposit. Whether amounts received from a bank, whether it is a deposit, whether amounts received from a bank, whether it is deposit. Like that, they have given 18. Any amount received from a bank or a financial institution is not a deposit. Amount received from a director, whether it is deposit, the answer is no. Whether it is received from a relative of a director, whether it is deposit. Only for private limited companies, it is no. But in a public limited companies, relatives also cannot give. Okay? Shareholder, whether amount received from a shareholder, whether it is deposit. Amount received from a shareholder is a deposit. For private limited companies, I think yesterday Vijay Raja must have spoken about that. There are certain exemptions to private limited companies, provided they comply with certain conditions. Otherwise, any amount received from a shareholder is a deposit received from a member. It is considered as deposits, unless you consider, and for the purpose also it is considered as deposit, but it is an exempted deposit. If you comply with the conditions, less than 50 crores borrowings to deposit, less than 2 ratio, not having any shareholders who are corporates, like that, there are certain conditions. So if you comply with those conditions, it is, otherwise money received from a member becomes a deposit. Okay. Then what about relative of a member? Yes, sir. Then you don't call them as shareholders, you call them as directors. Yes. Absolutely. Absolutely. No problem. Because you are directors. At the time of receiving money, they should be directors. The question that comes out is, let us say Director X had given me 1 crore in 2011. Today he is not a director. In 2021-22 now, he is not a director. Now what I am saying is, the rule says when he is giving it, he should be a director. Subsequently, if he resigns, not my problem. Okay. Anyway, more on deposits in the next session. Okay, what were we talking about? Yeah, deposits, section 73 to 76. You will have to read 4 sections, breach of which is very, very dangerous. 2 crores or the amount of deposit collected, whichever is lower. That is the penalty. No? Then 148, maintenance of cost records. Who should maintain cost records? Not every company. Then we have 6 regulated and 33 non-regulated sectors. You'll have to look into whether you are under the regulated and non-regulated. Only then the question of maintaining cost records comes into picture. So at least one section. Section 42 and 62, preferential allotment or private placement of shares or convertible debentures. Section 197, managerial remuneration, which we have already seen. 177 and 188. Okay, no? Related party. Related party has already been dealt with yesterday, right? Related party 188 and 177. Of course, ROC was also talking about when you're dealing with 177, 188, you also have to look into accounting standard 18 or Ind AS 24, as the case may be, to comment on this. Then section 192, non-cash transactions with directors or persons connected with them. We'll see what it is. Section 143, subsection 12, fraud reporting. Balachandra Chadagore, 143, subsection 12, fraud reporting. ADT 4, in case the auditor comes to know of any fraud in the company, you will have to report it under 143.12. And not only reporting to the central government up to 1 crore to the audit committee. Not only that, again, there is an added responsibility to the auditor to comment on that in CARO. Okay, we'll talk about this post lunch. 135, we have seen CSR reporting. Now, at least 50, now, out of the 20 points, what I wanted to tell before tea is, out of the 20 points, there are a few points which an article trainee, probably a good trained article trainee, can answer, or a person with general commercial knowledge can answer. Then there are a few questions only a person with knowledge in Companies Act can answer. Now the ones which I given below, whether the property, plant and equipment, all the documents, the title deeds are in the name of the company. Iske liye Companies Act ka zarurat hai, sir. What I'm saying is, for answering this, the first bit there, I have just split CARO into 2 boxes. Box 1, to answer that, you need to have a thorough knowledge of Companies Act. Box 2, you will have to have general accounting knowledge, commercial knowledge, whatever it is. So property, plant and equipment, whether proper records are maintained, physically verified by the management, and accounting for discrepancies, title deeds of immovable property in company name, details of revaluation, proceedings under Benami Act. Inventory, physical verification by management and accounting for discrepancy, agreement with the books of accounts and quarterly returns filed to the banks. Unrecorded income disclosed in the IT assessment, whether properly recorded in the books. Statutory dues, regularity if undisputed, details if disputed. This has been there, we will continue. Repayment defaults to financial institutions, banks, government, debenture holders. Now please understand, if anything is in red, here, the comment is also required under Schedule 3. In fact, I will tell you, this Schedule 3 changes. There are a lot of changes in Schedule 3 is there to protect the auditor, because the company has to primarily disclose that in Schedule 3, provided the company prepares the Schedule 3. Okay, having said that, if they prepare the Schedule 3, then for the CARO auditor, he is protected to that extent, because we'll say based on the financial ratios, I'm saying that the company has the ability to pay, repay its funds in the next 1 year. Where are the financial ratios? Earlier, I had to calculate as an auditor. Now it is already there in Schedule 3. That's the point I'm trying to say. So repayment, if term loan, if diverted, where have they been diverted? Funds taken to meet subsidiary, associate, joint ventures obligation and willful defaulters. So these are the ones which read have come in only in 2020, and also there is a requirement to be told in Schedule 3. Application of funds raised by way of IPO, FPO, whether they have been applied for the purpose for which they have been collected. Nidhi companies, registration under 45(1)(a), most important, of the Reserve Bank of India Act. Let us spend a minute there. What is this 45(1)(a)? Every NBFC which wants to collect money from which has to be registered as an NBFC, should go and register it with Reserve Bank of India. This is the first requirement. Then there is a second requirement. This is, you have to go and register, for which there are certain conditions. Your net owned fund should be minimum 2 crores, etc., etc. Then there is another condition which says, even though you are not an NBFC which is registered, by virtue of complying with the principal business test, wherein your principal business is financing activity, you are deemed to be an NBFC. Now, what is your principal business? Financial assets. They say if your financial assets are more than 50% in your balance sheet, and please understand, and your income out of your total income, more than 50% happens to be by such financial assets, then you are deemed to be a NBFC. One is you have gone and got the registration. The other one is you are deemed to be an NBFC. So if you are out of the total asset, more than 50% are by virtue of investments. Financial assets could include FDs also. But what the circular has told is FDs are not to be reckoned for the purpose of 50% here. They have excluded that. And okay, you have passed this test. Then you go to your income side. More than 50% of your income is by virtue of dividends, interest, profit on sale of investments, etc. Then you are deemed to be an NBFC. What is the role of the company and the role of the auditor? The role of the company is they should go to Reserve Bank of India and register it. The role of the auditor is to see such a registration has happened. If not, he has to comment it in CARO that although they were deemed and they're required to register, they have not registered. And there is a need for such an auditor to directly write to Reserve Bank of India saying that there was a need and they have not done. Just telling it in CARO is not sufficient. These are the, yes.
This responsibility by the Act, CA Act, or is this by the Companies Act?
By 41,
is it?
No, it is coming out of Reserve Bank of India Act.
Okay.
And now I would say CARO also. CARO reporting, Reserve Bank of India wants you to report it, not under the CA Act.
I thought you were referring to no clerk clause.
Yeah, no clerk. Okay, no clerk is something else. So right now, you may be actually selling garments, and you sold the building, and now you have got surplus funds which you have now invested in mutual funds or some shares or stocks. You are not an NBFC. Your main objective is still saying garment manufacturing only. In spite of that, you are deemed to be an NBFC if your total investments is more than 50% of your total asset, and look into your income. If you don't have any income, or less than 50% of your total income is from such investments, then you are not an deemed NBFC. No, let us be clear. Okay, what you are saying is investment in building is not an investment for this purpose. Investment in building is not an investment for the purpose. It's not a financial asset. So rental income obviously is not a financial income from such financial asset. Okay. So ability to meet the company liability in the next 1 year. Statutory auditor resignation. Consider issues, objections or concerns raised by the outgoing auditor. Internal audit system, of course, we have already seen, and cash losses. So this is in totality the Vishwarupa of CARO. Now it is 11:29, one more minute before we go for tea. What is that we are going to deal with the third session? In the third session, we will take up each of the clauses and see what should be the audit requirement for each of these clauses and how am I going to answer it. So I will not take you through the PowerPoint after in the third session, probably. Maybe some here and there I will take up, but I will be going through the possible answers for each of these 20 points. Now, audit report we have seen, this we have seen. Yeah, please be aware that audit working papers is the most important thing that you have to keep preserved for your own safety. Okay, that, and how many years you have to preserve the audit working papers? हम लोग ये बोलते थे कि कंपनीज एक्ट में 8 years, कंपनीज एक्ट में 8 years, इनकम टैक्स एक्ट में पहले बोलते थे 6 साल, अभी भी बोलते हैं सेक्शन 44 ये you know, and read with the rules thereof talks about 6 years, whereas audit working papers हम इनको भी नहीं एवरेज करके 7 साल बोलते. So that is how income tax is 6 years, Companies Act is 8 years. For me it is 7 years. So where is it told? It is told in SA 230 as well as SQC 1. This is what I was talking about. Now when you, maybe I think we can continue this after 11:30. General provisions on CARO. So we have Tirupal, and what is the time now? 10 to 11:30, 11:30 to 12, long back, huh? Okay, giving too much of tea.